Hello and welcome back to Investing for Generations, your channel for high quality stock research for long-term value investor. And today I want to take a look at the big players at the market, the biggest companies in the world, who was also beaten down by the late correction in the market. And so I will take a look at the valuations of Apple, Amazon, Netflix, Google, and Microsoft, and will tell you if I think it's already a good time to buy into these great businesses. Overall, lately the market corrected quite a bit. For example, the S&P 500 lost since the start of 2022 around 9%, and so it's time to look at the best companies in the world and just decide if it's already time to buy in. And because all of these businesses are the best of the best, I will not look into the fundamentals as I do normally here in these videos. I will just look at the valuation and concentrate on that. Because price is what you pay and value is what you get. Let's see if there is a good risk and reward ratio already. And let's start with Apple, which lost from his all-time highs around 12%. Let's take a look at the current valuations. So Apple right now have a market capitalization of $2.655 trillion with a PE ratio of 28 and a forward dividend yield of 0.55%. So let's try a calculation of the intrinsic value. And therefore, as always, we first of all have to know what we expect from our investments. And for me, my expected return for the investment in the stock market is 12%. Next up, we have to know the estimate growth rate. This will be wrong all the time, but at least we have to try to estimate that, and I'm very conservative with these estimations. And for Apple, I would estimate for the next 5 years a growth rate of around 10%, and for the years 5 to 10 of 8%. And last but not least, we need a terminal multiplier for the valuation. Right now the P ratio is 28, and I go here with an estimation of a terminal multiplier of 25 in 10 years. And when I calculate the intrinsic value with these metrics, then I come to an intrinsic value for Apple of around $135. And so from the current price of Apple of around $162, it looked to me that Apple is still overvalued of around 16%. So no buy for me, even if Apple, of course, is a great business. No doubt about that. Next is Amazon. Amazon lost around 23% from its all-time highs already and is right now traded at around $2,800 with a market capitalization of $1.452 trillion, a PE ratio of 56, and no forward dividend. So when we try to calculate the intrinsic value of Amazon from the current earnings, then of course again we have an expected return of 12%, a terminal multiplier of 30, which is, I would say, reasonable, calculated with a growth rate of 15% per year over the next decade, which I think is possible. It feels to me already high because this business is so big, and then the question is, can you really grow at these levels over another decade? But of course Amazon have a lot grow potential also on the cloud business, let's say the 15%, and when we calculate then the intrinsic value, we come to a intrinsic value of around $2,000. So it seems like Amazon, even after that drop, is still overvalued. And just to make this clear, to come to an intrinsic value of $2,800 like we have it now, Amazon would need a growth rate over the next decade of 20% per year. This could be possible. I will not say this is impossible. The risk of disappointment or slower growth than 20% is just too high for me, and so the risk and reward with the investment in Amazon at the current prices is just too high, even if also as Apple, of course, Amazon is an unbelievable great business. And then a personal note from that, I sold Amazon years ago, many years ago, for around $500. At the time, I made a profit of around 50%, was very happy. One of the biggest mistakes in my investment career. Next up, Alphabet, better known as Google. Alphabet lost around 14% from the all-time highs and is currently traded at around $2,600 with a market capitalization of $1.734 trillion and a PE ratio of 25. When I calculate the intrinsic value of Alphabet, I estimated a growth rate for the next 5 years of 10% and for the years 6 to 10 of 8%, with a terminal multiply of 20. So I would say also conservative. And with that, I come to an intrinsic value for Alphabet of $2,359. And so Alphabet also looks a little bit overvalued, but not that much. So this is really interesting. My target price to buy into Alphabet would be around $2,300. Normally, I like to buy my companies with a margin of safety of at least 20% to the intrinsic value or my calculated intrinsic value, because I'm not that confident that I'm always right with that. So I need a margin of safety for myself. With these great companies like Alphabet or even the other two, I would be very happy if I can buy them on the intrinsic value. And so at $2,300, it looked a great long-term investment. And we will see if we ever will see these prices again. At least for me, Alphabet at $2,300 would be very, very interesting, and I would take a first position. Then take a look at Microsoft. Microsoft also came back from an all-time highs around 15% and just published their earnings yesterday, and they brought very good quarterly earnings yesterday. So nothing to worry on the business side for Microsoft, I would say, as always. And so Microsoft right now is traded at around $300 with a market capitalization of $2.259 trillion, a P ratio of 33 and a small dividend yield of 0.86. Also here, let's try to calculate the intrinsic value. My estimated growth rate for the years 1 to 5 was 12%, for the years 6 to 10, 8%, with a terminal multiply of 25. Also this, I would say, overall very conservative estimates. And with that, I come to an intrinsic value of around $250. And so also Microsoft still look overvalued, but also not that much. And so also Microsoft very high on my watch list. And of course, when this correction continue, or even we really get a real crash, then I also would buy Microsoft on this intrinsic value of $250. This would be my target price to buy. We will see if we ever see these prices. I made these calculations also before, and then I just was too mean to buy. We will see if I get the chance to own these great businesses in the next bigger correction or crash. Maybe we are just in the middle of that. Then, last but not least, take a look at Netflix. Netflix just published their quarterly earnings a few days ago, and after that the stock just dropped over 20% because the subscribers slow down, just the growth slowed down, and so Netflix was hit really, really hard and lost overall from their all-time highs over 40%. Right now, Netflix is traded at $380 with a market capitalization of $168 billion and a P/E ratio of 33. And with Netflix, I really have a problem to calculate the intrinsic value because it's so difficult to find for me a reasonable growth rate for the next decade. And the reason why this is so difficult to me is because the competition is so high and the space to grow seems to me just limited. I really don't know how really reasonable to calculate the intrinsic value. So I calculated the growth rates which was needed to come to an intrinsic value of the current $380. To come to an intrinsic value of $380 with a terminal multiply of 25 is 15% per year over the next decade. This seems to me a lot. With all the competition of Disney Plus, HBO, very, very difficult to reach these growth rates over the next decade. Of course, if they reach these growth rates, if they even reach maybe 20% per year, then of course right now Netflix is an absolute bargain. Then you should buy as much as you can. For me, the risk is just too high. And so I will not touch Netflix even after this massive drop. That's my view on Netflix. Please let me know in the comment section what you think about Netflix, the most discussed stock right now. And so I would like to know your thoughts on Netflix. For me, the better option if you want to play the streaming business is Disney, because with Disney you get the streaming service Disney Plus plus all the rest of the very great Disney business. When you follow me for a while, then you know that I bought Disney in the depths of the pandemic crash in 2020, in April 2020, for $101, and then later on May 5th of 2021 I sold my Disney stocks for $183. So I made a profit of over 80% with this trade because at the time I just thought it's overvalued at this moment. And then lately, now in the correction or even before, also Disney suffered a lot. The Disney stock price suffered a lot, and currently we are at a stock price of around $137. So also Disney came back a lot. And so Disney seems to me the better play overall. And at prices of around $120, Disney become really interesting to me again. And I think I will buy position in Disney when we reach the $120 mark. This seems to me the way better play in the streaming service compared to Netflix, because here you get the streaming service plus the very great business of Disney overall. And so overall, I would say we have still high prices in the market, also, or maybe especially with these very good quality businesses, but some of them could be really interesting if the market correction goes on. And so I told you my target prices, and when we will reach these prices, then I will buy into this companies. So that's it for today. Thanks for watching. Let me know in the comment section what you think about these great businesses and what's your plan or what your target prices to buy into these great companies. Also, if you want to support me, you can do that via PayPal, Investing for Generation. Thank you for that. If you like this video, of course, give me a big thumbs up, subscribe to the channel, and then we will see the next time on the weekend with my weekly update of my real money portfolio, where you get a full insight to this portfolio. If you're interested in that, just subscribe to the channel, ring the notification bell, and you will never miss another video. And then we will see the next time on the weekend. That's it for today. See you the next time. Take care. Bye bye.